Hello guys, and thank you for joining our first English OneRoyal webinar. We are excited to have you here. Hope you will enjoy the session, and please prepare your questions for the end of the session. We will keep 10 to 15 minutes for your questions. So, a quick disclaimer here. Please do not take our information for, let's say, as an investment advice. Do your own research before starting. Today's topic will be how to trade CFDs. So these are the bullet points that we will talk about. What are CFDs? Main use of CFDs, advantages and disadvantages of CFDs for sure, how CFDs work, and finally we will show you a real live example using MetaTrader 4. So first, what is CFD? CFD stands for Contract for Difference. So it is an agreement between the trader and the broker where at the end of the expiry date you will exchange the difference between the closing price and the opening price. So in summary, as a trader, you will bet over the price fluctuation or the price movement to make certain profit. So you will benefit from this volatility to be able to make money, either to the upside or to the downside. We will talk about this later on. CFD, it is a leverage derivative. What I mean by leverage, it is a way to trade CFD where the broker will amplify your account. It will give you like more money, so you will be able to trade bigger amounts. I will explain it deeper in the second and other PowerPoints. CFD you will not have an ownership, so you will not own the underlying asset when you trade the CFD. So let's say you decided to buy Bitcoin or Euro, you will not own the underlying asset. What you will do is you are betting over the price, as I said before. Also, there is no delivery and expiration at the end of the contract, similar to future contracts, okay? You can trade CFD based on financial assets such as stocks, indices, commodities, and recently cryptocurrencies. So it's like an advantage that you can trade all available financial markets if you would like. What is the main use of CFDs? The main one is speculation based on price movement. So your own or your main goal using CFDs is to make profits, as obvious. So if you look at the right of this PowerPoint, we have this graph. This is how you will profit from CFDs. Let's say you have decided to buy a certain CFD. When you're deciding to buy or go long on a certain asset, that means you are expecting that the price will go up. And let's say the market moved into your direction and went up, then you will make profit. And this profit is the closing price minus the opening price. However, if the market went against you, that means the market went down when you bought this CFD, then you will accrue some losses. So here we have this term called margin. Margin, let me explain this keyword here. Margin is like a deposit or guarantee taken by your broker to be able to trade bigger accounts, which is the leverage. Okay, so margin, keep in mind that is like a guarantee or deposit, so you will be able to trade big. However, if your losses are bigger than a margin in a certain position, then the transaction will be closed and you might get a call from your broker, so you will add more funds if you would like to trade more or furthermore, yeah. Another way to use CFDs is to hedge. This is mainly used by financial institutions and corporates, so they will protect themselves from price fluctuation by using CFDs. We call this as hedging. We will not dig deeper in this subject, but you should know about it. Another way to use CFDs is for investing. So we have trading as obvious and investing. In trading, we have three different styles: day trading, swing trading, and position trading. Day trading, it is a kind of trade where it lasts maximum few hours, or at the end of the day, your position should be closed. This is called as day trading. Swing trading, your trades last between a few days till 1 week, and position trading, any position that lasts more than 1 week. Now we will cover the advantages and disadvantages of CFDs. First advantage of CFD, it is a leverage asset, as we have talked. So you need small account or small amount of money to be able to trade big. More money, that means more profit. Okay, but for sure there is a certain risk that we will talk about it in the disadvantage. For now, know that it is a leverage asset, as we said before, so this is an advantage. In CFDs, you can go long and short. What we mean by long and short, so when you go long, that means you're expecting that the price will go up. You say, I am long on euro. However, if you're expecting that the price will go down, then you will go short. And then you will make money if the market goes into your direction, that means to the downside. Another advantage that I would like to talk about is that in the CFDs trading, you can trade multiple financial markets using one account. So using OneRoyal account, let's say you can trade Bitcoin or cryptocurrencies, Forex, stocks, and etc. using just one account, which is really good. Finally, CFDs are 24-hour trading assets, so you can trade them all day long. And for cryptocurrencies, you can even trade them in the weekend. Oh, sorry. Now, disadvantages. So as we have seen at the top, that it is a leverage asset where you can make more profit since you are using bigger account using the leverage. However, there is downside for this, which is you can make also big losses. Okay, so here you should learn how to risk management, which is a topic we might cover it in the future. So if you are able to manage risk, then you will benefit from leverage. So you should be aware of this risk. There is also another disadvantage, which is overnight financing cost. What we mean by this, so if you leave a trade overnight, then you should pay an overnight fee, which we call it as well as rollover interest fee. So you will pay it if you leave a trade overnight. Next, we said before that you will not have any ownership when you trade CFD. So you will not own the underlying asset. So now we will talk about how do CFDs work. So I will open the MT4 and I will give you an example how CFD work. So here we have the US 30. Okay, so let me make it clear for you a little bit. Okay, so here we have the CFD 30. Let's say you decided to trade this asset. If you would like, let's say, to buy, or you're expecting that the price will go up, so we are here, let's say, and you are expecting that the price will rally or go up from this price, what you will do is you will go buy or you will go long, you will use this button here, as simple as this. However, if you are considering that or you're expecting that the price will go further down in the coming hours, what you will do is you will go short. So we say you short sell by using this button here. Okay, some platform use bid and ask instead of sell and buy. The difference between sell and buy, we call it as spread. And this spread will be the fees taken by your broker when you open a position. Okay, so I will repeat. Let's say you are expecting that the market will go up. So what you will do is you will go long. However, if you expect that the price will go to the downside here, then you should go for short sell and you will press this button, let's say similar to this. So you can see now that I entered into a trade and here I have some profits and the market is going to the downside. Okay, this is a quick example. Okay, don't take it as a real life example. What else? I will talk about the position size. If we go here at the properties or specification, sorry, here, there is the contract size. So here we have the contract size. We have 1 unit for, so every time you press 1 here, or the position size 1, that means you're buying 1 unit of this index, okay? And for sure, since you're trading based on margin, you will not pay the whole amount, which is 33,000. As we said, since there is leverage or you're trading based on margin, you will pay a certain or small amount of this 33,000. And then the broker will help you to amplify your account to be able to trade the 33,000. So what you will do is you will pay a small amount. It depends on the broker. For OneRoyal, you should pay just 0.05% of this amount to be able to trade 1 unit of US30. I go here and you can see it. So the margin percentage is 0.5%. That means 0.005 of 33,000, which is around 160, I think. Okay, I will give you an example later where there is some calculation to understand how it goes. So by using 164, you will be able to trade 33,000 or 1 unit of this index. What else I need to cover? Yeah, so margin and leverage, I will explain it more in the next slide. What you should know that margin is like a deposit or a guarantee. However, leverage, it will amplify your account. Financing charges, as I said, it is the spread between the buy and the sell. So if you do this minus this, it is the commission taken by your broker. Yeah, this is the fees that you will pay mainly when you trade CFDs. Now we will give you an example of a CFD or the calculation behind the CFD trading. Let's say we have the instrument US30. Okay, and we decided to go long. As you remember, when you go long, that means you are expecting that the price will go up. And when you expect the market will go up, that means you are expecting to make profits for sure. So if you're long, that means you're expecting that the market will go up. And let's say this occurs and the market went up from 32,955 till 33,000. That means you made a profit of $45. Okay, so if I go to the upside here, I will explain a little bit what is margin requirement. So as I showed you here, we have the specification. So the broker is asking from you every time you trade just a deposit of 0.5% on any, let's say, transaction that you will open. So you need just a 0.05 times the amount to be able to trade a certain CFD. If I go down, so 0.5% of 32,955, it is $164. This is what you should deposit, and then you will be able to buy this US 30. So we are expecting that the market will go up, so we are long, and here it went up. So as well, I need to relate the margin to the leverage. Since the margin requirement is 0.5%, the leverage is 200 to 1. How did I get this? If you divide 1 divided by 0.05, which is 0.5%, divided by 100 is 0.05. So 1 divided by 0.05 is 200. 200 to 1. This is the leverage is expressed in this form. Margin is expressed in percentage. So what does it mean 200 to 1? 200 to 1, that means every time you deposit $1, you will be able to trade $200. So it will amplify 200 times your account. It's like giving you a loan of 199. So this is the power of leverage. Let's get back to our example. So here we made a profit of $45, which is this minus this because the market went up as we expected. So you made $45 times the one contract. We bought one index. So this is the profit. Now I will show you how this profit is compared when it comes to spot trading and CFD trading. In spot trading here, what I mean is when you buy the whole index or the whole amount with cash account. So you need the 32,955 to be able to trade based on spot trading. However, in CFD, you need just 164. Okay, so if you made $45 divided by 32,955, which is the initial amount you need to trade based on spot trading, then you will do as percentage-wise 0.13%. However, in CFD, you will make $45, which is this amount here, divided the initial amount. You need just a small amount to trade based on margin. So 45 divided by $164, this is 27%. So you can imagine how much big the profits if you compare them with spot trading. In spot trading, you will make 0.13, and in CFD trading, you will make around 27%. If you divide 27 divided by 0.13, this is around 200 times, which is the leverage that we have talked about. So it amplified 0.13 till 27%. Okay, so this is it, guys, for this webinar. I will wait for your questions, and thanks for attending. I will wait meanwhile for the questions. Feel free, guys, to post your questions if anyone has. Okay, sorry, I just seen the question. Okay, what is the best asset to trade CFDs? There is no best asset. It depends on what you prefer when it comes to trading. For me, I prefer crypto and Forex. So you should discover this. It's like a preference based on each person. Okay, Sophia. Yeah, for sure, we can give you an example of a losing trade. Okay, so here, okay, let me close this. As we can see, we have the market that is going to the downside. So I will go buy, okay? So for me, I'm expecting that the market will go up. However, the market is going in the opposite direction, but I will go buy. So if you go buy, that means you're expecting the price will go up. However, the market is going to the downside. So when the market is going to the downside, you should start to lose. But here we have a small retracement. Let's wait a little bit, and then you will see how the market. Okay, here we can see that this is the entry, which is around 33,133. So if the market start to go lower than this price, you will start to have losses here, as we can see now. Okay, so the price now is 33.1. I don't know now. It's so volatile, so I cannot give you a precise number. But if it goes lower than 33,133, then you will start to make losses. Okay, because you are buying US 30. Okay, you're going into the opposite direction of the trend. Okay, any other question, please? Okay, great. So thanks everyone for those who attended this webinar, and see you in another session.